All right. Hello, everybody. My name is Darwin German. And for those of you who have not listened to one of these before, I'm going to go through the business plan for Amber Creek and Trails Place. These are two smaller properties we have under contract and that we are going to be buying in the next month and a half or two. And it's 125 total units. There's Amber Creek and Trails Place. Individually, these properties are 61 units and 64 units, combined 125 units. Normally, we would not buy properties that small individually. We don't have a lot of luck with them because there's not a lot of economies of scale that you can get from a smaller property. You need to have at least 100 units to have it make sense. So we're buying Amber Creek and Trails Place. Now, they are in Wiley and Garland. They're not too far apart from each other. So we can have one manager and two maintenance people oversee both of these properties combined. And so that we can still get our economies of scale without having to break it up between a bunch of different properties, since this is going to be under one ownership entity. So Amber Creek and Trails Place, this is the marketing piece that you get from a broker. It's called an offering memorandum, OM for short. You would see that up at the top, OM. And it's their pretty package to sell the whole property, to sell the project. Now, you can take a look at these and just glance. I'm seeing, for example, I'm looking at this going, okay, pitched roof, that's good. Carports, that's good. Concrete driveways, that's good. Built in the 80s, that's good. So just on a first blush, I can look at that and say, okay, I like some of what I see here, so let's keep on going. All this, their basic stuff. And then the pool. Now, they've got these divided up into two different properties. They don't have them combined anywhere, which is kind of a pain in the butt because we had to go through and combine them ourselves, which we would do anyway. But still, taking two sets of financials is still a pain in the butt. So Amber Creek, this is the big thing that they sell right here. $5.21 million in potential value creation. They're saying that on Amber Creek, now this is Marks and Moschop, the long team, saying with the unit upgrade program, spend $10,000 per unit, which is $640,000, you can increase rents by 303. I want you to remember that. They think we can raise them by 303. Now, we went through and did our market study. We looked at all the competition, et cetera, and our estimated rental increases with these upgrades is only about $200. So we're being way more conservative than they are on their marketing package. Then on Trails Place, they think $436. And again, we're only raising $200 across the board, roughly. So not too bad that they think that there's that much value creation there. We'll keep on going through. Unrenovated units, which is always good because we know we can upgrade them and raise the rents. Drastically below submarket, and 40% water savings conservation program. So one of the properties on Amber Creek, we actually got bids from Save Water Co., which will show, I'm going to pop over to that real quick just so that you can see it. Here is their quote. This is what Save Water Company says. They go through and they audit this. They say you're spending $68,000 a year on water right now, water and sewer. But for a cost of $51,181, they'll go through, replace all the toilets, aerators, fix leaks, etc., and your new water bill will be $41,000. So a $27,000 savings on the water bills. So we've done this on quite a few properties. It's usually pretty accurate, and we do get a lot of savings. So we budget that into our overall program. Getting back to this, so they're saying 40% water savings, which we do have plugged into our numbers. I just want to give you the broker's assessment real quick. Another big benefit, individually deeded parcels. So because of that, what that means is that these are individually deeded as condominiums. And because of that, you get appraised. Your tax appraisals come in through the residential division rather than the commercial division. And commercial is extremely aggressive. Residential only goes by what the sales comps are. So they look at other condos that sold in the area to come up with a value. And what that does, that keeps it very low. We do have our tax consultant who went through and budgeted what they think our taxes are going to be after we negotiate them. And I'll show you down on the spreadsheet when we get there. 2 and 3 bedroom units, and offer free and clear. That's a big thing right now because you want to put new debt on it rather than assuming old debt. Then it just goes through where they're located, which is not too far apart, and just some more pretty pictures. We'll go ahead and scan through those. But I'm sure you'll look at the video, and the video that we also have attached, which is our drone tour and narrative, so you can see all the pictures you want and the video of seeing the entire properties. Nice floor plans, 2 bedroom units, nice layout. Now they say capital improvements, recent capital improvements, roof replacement, that's good. Glass repairs, pool repairs, exterior, they didn't spend a lot on that. So it needs a lot of updating, which we've got budgeted in there. Median household income over $60,000, which is good because our residents need to be able to afford where they live. Okay, so now I'm going to skip on over to our actual analysis. Again, this is the investment presentation. Now, this is attached in your private placement memorandum when we go over the property. So this is just a detailed analysis of our business plan of what we're going to do with the property. What's funny is I don't see a lot of people that go through and do this to show you how we come up with the numbers, when we make projections, and how we actually got there. So I think that's something unique that we do, that we provide all of the backup, and you can get additional backup if you would like. But this is the whole business plan, that we take all of the data from due diligence, from CoStar reports, from walking the property, from getting bids from contracts and everything. We put this into this business plan so that we know what our goals are for the property. So let's go over here. Trails Place in Amber Creek, again, in Garland and in Wiley. We're paying $23 million. It's $186,000 per unit. Now, on that $186,000 per unit, these are 80s constructed properties, and Wiley and North Garland, which are better areas. So we've got good product, good properties in good locations. We plug in our closing costs, capital improvements of $12,280 on average per door. If you remember, they had $10,000 on interiors, but we also have another $2,000 on exteriors, roughly. Capital improvements. Now we put $250,000 in our operating account so that we have cushion there to be able to pay bills, et cetera, while we float. I put in a miscellaneous number of $41,000. There's always little expenses that pop up here and there, and we plug that in for 2 reasons. One is we want to have some type of cushion or miscellaneous cost, but then I also have an odd number there to round off our capital raise of $7,650,000. Our loan amount, $18,588,750 as of right now. We are still getting loan quotes. We've had loan quotes as low as 1.75% interest fixed for 2 years. And so that was very intriguing, but it would have a lower loan amount versus a higher leverage amount. This year is 75% loan to cost. And like I like to do on these is just a little show you how these things work. Okay. For example, if we could only get a 70% loan, 70% loan to cost. Our return here, the 5-year average investor ROI goes down to 13.5. Okay. Not very good. If we have an 80% loan to cost on a bridge loan, then the return jumps up to 19.4. So it all depends on what kind of debt we can get. And we've had quotes in all areas from 65 to 85. And so we just have to get the best mix for what we want to do. We also don't want to be stuck in a bridge loan with one of these debt funds that are like similar to loan to own. They loan you the money expecting you to default, almost hoping that you default in 2 years so that they can take the property back. Whereas bank financing, if you go with a regional bank, for example, they portfolio that loan. They don't want the property. They just want the loan paid. So, and they'll also extend the loans rather than waiting until your bridge comes up and then you're stuck having to pay it off. In DGRE, the whole team is the sponsor. 16% of the overall goes to the sponsors, 4% to the guarantors, and we do have an acquisition fee in there of 3%, and that goes to the team as well to go ahead and pay for all the overhead in putting the whole deal together. Business plan, it's a value play. What's nice is we've got a 39% projected year 3 cash out refi. So 39% year 3 cash out refi, which is absolutely great. It's hard to find value plays, and it's also kind of shocking to say $186,000 is a value play. But nonetheless, it still is. Plus, our tax benefits, our accelerated depreciation, we're looking at 50%, 50% year 1 tax benefit. So, for example, you invest $100,000, you can expect a $40,000 to $50,000 tax write-off year 1, plus an overall of 16% 5-year average annual return and 39% of your cash back in year 3. And again, refinance dollars, those are tax-free. Let's show you something else here real quick. Our loan amount, which is mirrored right up here. Interest rate, 3.75. Okay, watch the 16% number. What if we were to get an interest rate of 3%? Well, that bumps it up 0.7 of a point. Okay. What about on our refi? Rather than 4%, what if we can get 3.5? Now it's up at 17. So we try and stay conservative on our interest rate. 3.75 is easily obtainable right now. And in year 3, 4%, we have to bump up. We have to assume that interest rates are going to go up. So we have to calculate that in there on our refinance. So many people go in there and they use the same interest rate on a refi, and they also use the same exit cap, which we'll get to that here in a minute. But my big thing is I want you to understand the numbers. You need to know how this all works so that you can be comfortable with the investment, in my opinion. Some people just say, hey, you're going to get an average of 16% average annual return, or 17% IRR, or 20%, whatever. And we want to be conservative on our numbers. We're exceeding, in many cases, our projections. And so let's go over and see what those projections are. Now, here's our current rent schedule. Here's the unit mix. 1 bedroom, 1 bath, 2 bedroom, 1.5 bath, 2 bedroom, 2, 3 bedroom, 2.5, and 2 twos. But 12 of those, 24 of those, 8 of those, 17 of those, and 64 of the 2 twos. Okay. Average square footage. I'm just going to jump down to average. So the total, 125 units. Average, 1,033 square feet, which is a decent size. Average rent, $1,135, which is only $1.10 a foot. $1.10 a foot is extremely low in this market. So that's why the broker thought you could raise it $300 to $400 per unit. Well, $300 per unit would be $1,435. Okay, $1,435 to $1,535. Now, this is our pro forma. This is after we go through and update the interiors and raise the rents. We're now assuming we're going to get $1,397. Now, that is a 23% rent increase, but we're also putting $10,000 per door into it for interior updates. So we need to get a return on that investment. And these rents are still within the market, not at the top, and definitely not at the bottom because we'll have brand new units. 125 units, actually built in 1983 and 1985. Pitch roof, individual HVAC, individual electric, individual hot water, B condition, 2 stories, brick and siding, slab foundation. So good, solid properties. Our improvement budget, we're putting in almost $1.2 million into interior. Properties are pretty nice already. Only $20,000 in landscaping, $16,000 for gutters, $57,000 for fencing, $2,000 for signage. We're not changing the names. The names are fine. Exterior lighting, $15,000. Carpentry and paint, $120,000 to update the exteriors. Parking lot repairs, $3,500. HVAC, $50,000. And that still gives us $73,000 in cushion, about 5% in additional cushion. If there's something else we find or prices are a little bit high, but generally speaking, we are pretty accurate on our numbers and can usually save money on our CapEx budget as we move on. What we do here is, this is the current numbers per the owner. So we put in what they're saying. We put in what, if we screw up, this is what it is. If we do really good, this is what it is. But we put our pro forma right in the middle there to go and say what we expect. Again, to show you high and the low and comparing it to what they're currently doing. So for example, the market rent right now is 1.7. Once we update the units, we're anticipating 2.1. Their vacancy and collection loss is a very low 2.1% right now. That's because rents are low. People aren't going to move. They're going to pay their rent because they don't want to get kicked out because they have low rent already. So there's a 2.1. We're anticipating year one at 10.5. Now we are increasing the collections. So rather than being $1.6 million, we're going to $1.8 million. So we think we're going to raise the rents by 15% over year one, roughly. Other income, 126. There's certain programs that we put in. We've got an internet and cable TV package that will save the residents money and makes us money. And it's a mandatory thing when they renew that they have to pay for that. We make about $40, $50 per unit on that. Plus the residents save about $100 per month on that package from going to buy them separately on their own. So we do a bulk package and sell it to them and make money on it. So we're going to take the collections from about $1.8 million to $2.02 million. So not a dramatic increase. Then real simple, 3% management fee. Our payroll, we're estimating at $170 with having those 3 employees. Contract services at $40,000. And again, you can look at the same thing, $40,000 for contract services. It might be $42, might be as low as $38. But the current owners are doing it for basically $38,000. So we bumped it up a little to have a little bit more cushion in there if we need to renegotiate something, if we need to add services, et cetera. General and admin, we just bumped that up also. Now, maintenance and make ready, we actually go down on because we are spending $10,000 per unit on interior updates. So because of that, our maintenance and repair costs are going to go way down for the next 5 years. So we go in there and redo everything on the interior. You don't have a lot of expenses. You don't have a lot of make ready. You don't have a lot of maintenance because we go in there and fix everything. So for the next 5 years, our maintenance and make ready costs should be low. Marketing, we bumped that up so that we can go ahead and fill that up because we're raising rents. We want all the units turned. And we have another property nearby. It's called Amber Creek. And Amber Creek in Plano, we were updating the units. Rents were $900. We were projecting $1,200. So a 33% increase on the rents in that property. And the existing residents saw the upgrades and just moved out of the older units into the newer units and paid the upgraded price. So that rarely happens. We found that rarely happens, but it does happen. And so we wouldn't have to spend much money on marketing, but we plugged it in there anyway. Utilities, again, that utility savings, we already saw that it was going to save over $20,000. We didn't put quite, they said $27,000. We didn't put the full reduction in there. Insurance, their insurance is $87,000. Ours is $103,000. That's like $865 per unit, which is high. And the reason that it's higher is because they go off of replacement cost to come up with per square foot, to come up with the replacement cost per square foot. We've got 1,000 square foot units on average. An average units are usually about 800. So we're 25% higher on our unit size, which is going to bump up our insurance costs. So you got to make sure to pay attention to that because $865, that is high. 3 years ago, we were looking at $350 per unit. So inflation's hitting everywhere. Now, property tax, current property tax are $154,000. This is where we always get slammed. I'm budgeting $300,000 because I want to be conservative in there. Now, our tax advisor is estimating year one at closer to $250,000. So we plugged in that in an aggressive, but again, I'd rather have it in here than not have it in here. But let me show you something. $300,000 for year one property taxes, okay? And we were at a 16% average annual return. What happens if just on that one, they are correct on $250,000? Now our return goes to 18.4. Pretty dramatic. Again, so I'm not projecting these high numbers. I'm trying to be conservative on everything so that we can hit those numbers, because occasionally there are bumps that you hit and something unexpected pops up. Now, we also have down here company expenses, which is taxes and asset management fee, et cetera. I plugged in $400 per unit for reserves, which is higher than normal on a property of this age. It's $250 to $300 usually. So again, extra cushion there. And I also put an extra year one $50,000 cushion, and that is a just in case number. That's just a wild number to put in there just in case something screws up. So additional cushion. You know, again, this is current owner, minimum, maximum, and what we're estimating. This number here then, this column, rolls over into our 5-year projections. Now, year one, we don't have any increase in income. That's because we planned on raising the rents 23% with all of these unit upgrades. Now, year two, I plugged in 5.5, and year three, 4.5. And normally, we always only use 3.5. I budgeted those in there because of inflation. Inflation is actually driving up rents a lot faster than the 3.5. But I want to go back to our normal 3.5 in years 4 and 5. But 23 in year one, then 5, and then 4. 5.5 and 4.5. Income, now expense increase. He was at 754 and we're at 855. So that's a good jump. What is that, about 7-8%? It's a wild guess, by the way. So year two, another 2.5%. Other than that, we just keep it at 2%. Collection loss. Here's the way that we do this. Vacancy is always at 6%. We anticipate having 6% vacancy at all times. With 6% vacancy and a 2% collection loss, that's about as effective as you can get. Overall, 8%. So that means you're pushing rents hard enough and allowing enough units to turn over so that you don't have higher occupancy, which shows rents are low, or lower occupancy that shows rents are too high. So we put it right there to be as efficient as we can. Other income, again, that goes up, same income increase. Management is based on 3%. And so these are our same expense numbers, okay, that we had right here, 855, 111, 855, 111, and 1165, 1165, and 323. You can see that that carries right on over from our pro forma to our year one. And then going out from year one, all that happens is these increases right here in income and expense. Do you have the cushion in there, $50,000? Now here is a big, big thing. I'm going to switch for a second because I should have shown you this first. This is, we put in there what a $100,000 partner can expect. So based on those numbers, a $100,000 partner owns 1.05% of the ownership of the LLC. They can expect year one cash flow distributions of $3,375, 3.4%. Not too bad considering this is a value play. Year two, $5,400, so 5.4%. However, in year three, we're going to refinance. You still get your $6,200 in cash flow plus $39,000 in refi proceeds. So again, refi dollars are tax-free when they're during the refinance, and because it's just drawing against your capital. It's your money you get back. So overall, that year is 45%. Year four, 4.6 in cash flow. Then we're saying we're going to sell it in year five, get $5,200 in cash flow plus $115,000 in sales proceeds. And that overall average is 16% per year, 79.8. So 1.8 multiple. So somebody that invests $100,000 over those 5 years gets $179,744. So those are what the returns are for the partners. Okay, this is the property level. This is what the property gets. This is what the partners get. Okay, based on $100,000, or for the larger investors, $300,000 investment. But the percentages are still the same, just the dollar amount changes. Okay. So go back over here. So year 1, year 2, year 3. Now in year 3, we're estimating a value of $32,390,000. So I want to show you something here. Now they're saying their current cap rate is 4.5. However, that is not accurate because you really have to look at a tax-adjusted cap rate. Because you have to say, because when I buy it, taxes are going to go up. Okay? So let's do a tax-adjusted cap rate. I'm going to combine these. Merge and center. Okay. Now, what that cap rate is, that is your net operating income. Now, I'm going to add back in the current property taxes and subtract out the projected property taxes and divide that by the purchase price. This isn't even the tax, so it's just divided by the purchase price. So we're looking at buying this. The current cap rate is 3.8%. Okay. So the tax-adjusted cap rate is 3.8. What people look at is they say 3.8 cap rate. Well, let's see if we use that on a refinance, 3.8% cap rate, and a value in year 5 of 3.8. Because that's what a lot of sponsors do. They look and say, just use the same cap rate going out as you got going in. So on this is a tax-adjusted cap rate. So at 3.8%, the returns now are 27% average annual return. Okay? Huge difference. But I don't want to use that because interest rates go up, cap rates go up. So I want to leave that at saying right now 3.8. Year 3, 4.3. Year 5, 4.5. Okay? To come up with a valuation. Okay, follow that? Because let's do this right here. See if we get that. Just this one, 16%. Watch that number. I'm going to change the exit cap rate to 4. Well, now it's a 24% return. So the cap rate, that exit cap rate makes the biggest difference in the overall scheme of what the returns are. Because what's the future value? That's where your biggest returns are. They're not from the cash flow. Cash flow isn't going to get you there as far as huge returns. It's the appreciation. And especially at a time with high inflation, what if let's do this again just for fun. Let's go ahead and say that, again, 16%. Let's just say that year 2 is 8% inflation. Okay? Well, now it's 18.4. Pretty dramatic. Pretty dramatic as far as what inflation does. So that gives us our year 5 value and the overall returns right here. So if you're interested in getting huge tax benefit year 1, so on a $100,000 investment, $40,000 to $50,000 write-off for year 1, plus getting cash flow 3.4 and 5.4 years 1 and 2, then year 3 getting $45,000 of your cash back. That's huge. That is a great return because now you can take that 45%, $45,000, $39,000 in refinance, or if you want to add the cash flow in there, and go reinvest that in another deal. Then you can keep on rolling that to get more and more investments. So this is our investment presentation. And just to go through to get to the front, or the trails and Amber Creek. These are nice properties. By the way, just a quick sidebar. I said Amber Creek earlier. The other property that we have in Plano is Amber Vista, and that's basically just east of downtown Plano, which is still close to Wiley. It's actually one of the comps for our properties that we're buying here. Okay? So we've already done due diligence. We've already gone through and got all of our numbers. We're ready to go. The only one we still need to nail down is the exact loan amount. We're going to raise $7,650,000. It'll be a mini max, saying that we can raise anywhere between $7 million and $8.5 million, so that we can get the property closed. We don't need the full $650 right off that extra $650 to close. And we also are going to do $8.5 million just in case there's debt issues, if we have to do a buy down, anything like that. But I think we're overall conservative in the numbers. Well, let's do this just for grins. Okay, that's 16%. Let's see what the numbers would look like if the broker's numbers are correct. And again, I'm going to go here, 16% average ROI. You can see right down here on the left. Now I'm going to take their rent and say $1,200, $1,500. I'm adding $100 to each one. So if the broker's numbers are correct and we can get an extra $100, then you're talking about a 22.8% return. Pretty dramatic. But I'm using a more conservative number because 16% is a great projected number. We've said 16% before and received 72% per year. So this is our presentation, investment presentation that's in the PPM for the Trails and Amber Creek. So we'd love to have you invest with us, love to have you be partners. We'll do a tour out to the property, and of course, we'll have a bunch more information that comes out to you in the videos, etc. If you have any questions, please let our investor relations team know, and they can answer your questions for you. And we thank you for investing with us. For those new partners, we would love to meet you, love to talk to you, see what your goals are, and help you out in any way we can. Now, we also just sent out $15 million back to partners on Gold Creek. So I anticipate this filling up extremely quickly. So if you are interested, make sure to let the investor relations team know ASAP so that they can get you in, because like I said, this will fill up extremely fast. So again, thank you very much, and look forward to having you as partners on the Trails in Amber Creek. Thank you so much. Bye-bye.